All right, good evening, everyone. I believe we can hear me very clearly. If you are in the class, if you could just kindly drop a comment. All right, good evening. As you can see on the screen, my name is Victor Anifooshe, and you can see a little description about me. Uh, and I welcome you to the JAM 2026 preparatory class for principles of account. All right. I'm sure that I believe we are going to enjoy this class, and I'm hoping to make this class as memorable, as relatable as possible, so that you can have the best results possible, even in your examinations. I wish us both a smooth ride together. All right. So if there is anyone that can kindly confirm that they can hear me so that I can proceed. All right. All right, let's get started. Let's get started. All right, JAM 2026 accounts prep. Um, Principles of accounts. Principles of accounts. Principles of accounts. All right. We are going to be starting with a little bit of introduction to accounting and bookkeeping to kickstart the class. And then, of course, from our subsequent classes, we are going to be talking about many other topics that is contained in the syllabus for your upcoming exams. And I must assure you that everything we are trying to do here is to ensure that you are in perfect shape, not just good shape, perfect shape for your exams by the time they come up. All right. So we are going to be starting with an introductory class for now. All right. If you can see the next slide, the objectives of this class is as follows. I believe that at the end of this session, you should be able to distinguish between bookkeeping and accounting. You should be able to understand the importance of accounting principles. You should also be able to identify and explain accounting concepts and convention. All right. So we'll be talking about majorly what is accounting. We also talk about what is bookkeeping. It's an introductory class, right? And then we try to find the differences, or let me say, we try to ascertain the differences between bookkeeping and accounting, how they differ from each other. Then we also tell you the importance of accounting principles, what accounting principles are, and we give an identification and explanation of concepts and conventions, of various concepts and conventions in accounting. All right, here you are. What is accounting and what is bookkeeping? You know, if I were you, I would take about 30 seconds to process this and try to think about what I actually understand about accounting and bookkeeping to bring this explanation into perspective. All right. So, but I'm sure you are doing that already, or you have done that. All right. If you are watching this video, you can just pause a little bit and then just reflect, and then we can continue. All right. So accounting principles. Accounting principles are procedures for transmitting financial information of an organization to the users of financial statement to enable users make informed decisions. That right there is a summary of the accounting process. All right. While bookkeeping is a systematic recording of transactions on a daily basis in the appropriate books, and it is seen to be the basis for accounting. Are we together? All right. Now let's give explanations. Let's give flesh to that. All right. So accounting is actually a process. But before you think about the process, let's think about what is the end goal of accounting. What is the main aim of accounting? Now, the main aim of accounting is to provide useful financial information to the users of financial statement. All right. Now, accounting is seen to be the language of business. It means that it is accounting that is used to communicate business. Do we understand that? Are we together? All right. Now, what we are saying is that just as I can communicate information to you using the English language, to communicate business information is account. It is accounting that serves that purpose to communicate what business information from, say, from the business to the users of the financial statement, to those people who are actually interested in what the business stands for and what the business is doing. So accounting is the sum total of all those systems that is put in place to do what, to meet the needs of the users of financial information. Are we together? So accounting exists to meet the needs of users of financial statement. That's the main aim of accounting. All right. So accounting now sets up a process to do what? To fulfill that goal. It sets up what? A process to fulfill that goal. It sets up a process to fulfill that goal. All right. Now, what's that process like? We have recording, analyzing, classifying, selecting, measuring, interpretation, and communicating financial information to the users of financial statement. So you see that there is a progression. You see that there is a progression of processes, or let me say notice you notice that there is a progression. You record, you analyze, you classify, you select, you measure, and then you interpret financial data of an organization to enable users make what? Make informed decision. So we said the first stage of accounting is going to be that you actually record the transaction. What do we mean by recording? We mean that when transactions happen, you write them down. That's what recording basically means. You write them down, you note them down. Somebody approaches you to buy something, you say so bought at so amount. All right. Then you classify and analyze transactions based on the type of transaction. You say this is a sale, this is a sales transaction, this is a what? A purchases transaction. A sales transaction, a purchases transaction. All right, this is an asset, this is a liability, and so on and so forth. Then at the end of the day, every transaction also has to be measured in monetary terms. All right, and that's what we know as measuring. All right, a financial value, a monetary value has to be assigned to all transactions. All right, then at the end of the day, now financial information or generally information will be useless without a user of information. Information is generally useless without a consumer, without the user of information. All right. So at the end of the day, the information that has been derived from the whole process of accounting has to be interpreted and communicated to the users of financial statement. Now, you might have this question: why is interpretation important? Why is it important to interpret financial data? Now, don't forget that I mentioned something the other time, that accounting is what? The language of business. Now, just like we all don't speak the same language, there is also a likelihood there are also many people that don't actually understand the language of business. I mean, they know what it is to do business. They know, or let me say, they know that this is a business and they have an interest, a stake in it, but they don't necessarily understand what's going on. All right. It means that to make it clear to them, or to bring those numbers into very clear terms, interpretation has to do what? Has to come into place. So before you communicate your financial information to the users, there is a need to actually interpret it. For example, if I'm speaking to you, I want to communicate something to you and I'm speaking French. there is a likelihood that you don't actually understand French. In that case, there we are going to need who? An interpreter to do what? To communicate what I'm trying to pass across in a language that you understand. So accountants, to sum up the work of accountants, they do what? They interpret the financial information, then they before they can communicate it accurately to who? To the users of financial statements. And the users of financial statements are those people that are interested in the process of accounting. You see, they can be owners of the business, they can be managers of the business. Another user of financial statements, we have what? um Government. All right, governments need your financial statement so that they can know how much tax to charge you. All right, your lenders means the people borrowing you money. Your creditors, people selling to you on credit. Your customers, all right, they need to see how well you are faring. Of course, also another one, banks, to so that they can know, they can assess whether they can, give you loans or something. All right, they need to check your financial information to see how profitable you are as a company before they can decide if they can give you a loan, or and how much they can actually give to you. Are we together? Right. So those are examples of users of financial statement. Don't forget them. We have the owners of the business, managers. All right, you have government, you have lenders, creditors, debtors. All right, and then you also have banks. And also, of course, we also have say analysts or other third parties that just need your financial statements to make certain decisions or to bring out certain insights. All right. So to repeat that, accounting is generally that process of showing a user of financial statement what is going on. Yeah, let's put it like that. Accounting is that process of showing users of financial statement what is going on in your business. And then, so to do that, there is a process of recording, analyzing, classifying, summarizing, measuring, and interpreting and communicating financial information to the users of financial statement. All right. Now let's talk about bookkeeping. Bookkeeping. Now, bookkeeping can be seen as a subset of accounting. Bookkeeping can be seen as a subset of accounting. Yeah, sorry about that. So bookkeeping can be seen as what? A subset of accounting. And bookkeeping is defined as the systematic recording of transactions on a daily basis in the appropriate books. And now you see that we noted something, that it is the basis for accounting. What are we trying to say? We are saying that there can be no accounting without what? Without bookkeeping. There can be no accounting without bookkeeping. Which means now you notice that the first item in the accounting process is what? Is recording. Is recording. Now, what we are the major difference that exists between bookkeeping and accounting is that the scope of accounting is actually wider than the scope of bookkeeping. To put it in a way, we are saying that the scope of bookkeeping is also what's limited, which means what bookkeeping covers is lesser than what accounting covers. Now, accounting covers recording, analyzing, classifying, summarizing, interpretation, communication, right? But bookkeeping only covers the systematic recording of transactions on a daily basis. So while accounting is a yearly function, a cross period function, right? A periodical function rather. Bookkeeping is a daily function. All right. So it is something that is done. I mentioned that bookkeeping just means, another name for bookkeeping is record keeping. As we said, it's like the process of you jotting down transactions that happened. All right, in a systematic manner. You're saying that, all right, somebody came up. If you're a bookkeeper, you say, oh, this time somebody came up and they bought so units of this. They bought so units of this. We also paid so. We paid salary, we did this and we did that. All right. So bookkeeping is noting down transactions as they occur. That's why it is short-sighted. All right. You record transactions as they occur on a time to by time basis, on a daily basis, while accounting shows the overall movement of transactions and financial information time. All right. Now let's look at some examples of between some differences rather between bookkeeping and accounting. Some differences between bookkeeping and accounting. Right. Now, number one is that bookkeeping is the basis for accounting, while accounting is a business language. All right. Now, if you see that, if you look at it, you would see that I've actually explained this. Bookkeeping forms what? The ground floor of what? Of accounting, the basis for accounting, which means that, okay, let's look at it this way. Bookkeeping is a foundation, while accounting is the house built on it. It's as simple as that. So accounting is the language of business, which means that is what you use to communicate what? Financial information to the users of financial statement. But bookkeeping, on the other hand, cannot be used to communicate financial information. It is, however, the foundation. So let's take a house for an example. For example, all right. So bookkeeping is going to be the foundation of the house. But of course, you cannot live in a foundation. Do you understand that? You have to live in a house, but there will be no house without the foundation. So bookkeeping is the foundation, while accounting is the house. With accounting, you can live in the house, but you cannot live in bookkeeping, which means that you cannot be satisfied with just record keeping. You must take it through the accounting process to derive financial information and communicate it to the users of financial statements. Do we understand that? Hence, the general name of accounting as what? Language of business. Number two, the person responsible for keeping records in bookkeeping is called what? A bookkeeper, while the person responsible for keeping records in accounting is called an accountant. All right, to put this into perspective, you are saying that the person engaging in bookkeeping is called a bookkeeper, while the person that engages in that broader aspect of accounting, or that broader discipline that is called accounting, is called who? An accountant. Is called an accountant. Is called an accountant. It's called an accountant. All right. Now, next one. So you with this, you have on the side, you actually have to make a decision on whether you want to be a bookkeeper. I mean, anybody can do bookkeeping, right? Because bookkeeping is just recording transactions. I mean, with a little training, you can actually be a bookkeeper, because what you just need to do is to record transactions. Tell us that so transactions happened, so transactions happen. Do you understand that? But accounting is a more specialized function that can only be carried out by a professional, and that professional is called an accountant. All right, that's that for number two. Now, number three difference that we'll be dealing with now is bookkeeping is just a recording phase, while accounting has to do with summarizing and interpreting. Bookkeeping is what? Is just a recording phase, while accounting has to do with summarizing and interpreting. This also reinforces the point that what? Bookkeeping is a preliminary phase, a basic phase, all right, a basic phase of accounting, while accounting is a more sophisticated practice. Yeah, let's put it that way. So bookkeeping deals with a limited phase, while accounting is broader, deals with more information, summarizing information, and actually what? Interpreting information. Number four is that bookkeeping cannot be used for decision making, while accounting helps to make decisions. Don't forget that we said that the final stage, or let me say the end goal, the aim of accounting. Why do we even do accounting at all? Is because we have certain people who are interested in our business, and then we need a process to be able to do what? To provide financial information to those people. To provide financial information to those people. All right. To provide financial information to those people. All right. Now, you cannot make a decision from just records. For example, somebody gives you a record of a business and says, bought goods for 50,000 naira, sold so for 50,000 for 75,000 naira. bought assets for so so. At the end of the day, you cannot make, you just read it and you'll be like, all right. And then what? You cannot make any reasonable decision from what? From those records, from records of transactions. All right. But you can make what? Decisions from what? From accounting. When financial information are processed, are passed through the accounting process, they are summarized and interpreted, then you can be able to do what? To make informed decisions, to make accurate decisions. All right. Is that fine? All right. Are we together? So, up to our next slide, I'll be talking about branches of accounting. Now, I'll be talking about branches of accounting as a discipline, then as a practice. All right. Now, when you are talking about the accounting as a subject matter, you have something called accounting principles, as you can see on the screen, accounting principles, accounting concepts, and accounting conventions. All right. But before I move to that, I also like to talk about some career path in accounting. All right, you can also look at accounting as a functional part, as a career path, and there are certain branches that you have under accounting. Now, the first one that I would be talking about is auditing. All right, auditing. Now, what is auditing? Now, auditing is a function carried out by an accountant. It is generally an independent examination. All right, audit is what? An independent examination of the financial information of an organization in order to make what? In order to give an opinion on if on the fairness and accuracy of the financial statement. What does that mean? Basically means that, all right, while preparing financial statements, we want to ensure something, fairness and accuracy. Now, an auditor is an independent accountant that comes to evaluate or examine the books of an organization, the financial statement of an organization, to assess, right, to check whether they have been prepared correctly. Let's just keep it simple. To check whether they have been what? They have been prepared correctly. So what's an example? Let's say I have a company, Victor Knows Accounts Enterprises, say VKA Enterprises or VKA Limited or VKA PLC. All right, I can prepare my account and all of that. Now, at the end, or let me say my accountant prepares the account and all of that. At the end of the period, I want to know whether my accounts have been prepared correctly and fairly and accurately. All right, so I bring in an auditor, he checks my books and gives me an opinion. He gives me his professional opinion on whether he thinks my financial statements were prepared correctly or accurately, and they actually show the state of my organization accurately. Do we understand? That's audit. All right. Now, another branch of accounting as a career is called, as a function, is called taxation. Note that taxation. All right. Taxation, if from economics, you know that tax is a levy that is paid, all right, to the government. It's a compulsory levy paid to the government. All right. Now, taxation is governed by rules on how to derive amounts and all of that, amounts that you are supposed to pay to the government. Now, as a business, you are supposed to do what? You are supposed to pay tax to the government. So taxation is that branch of accounting that helps you to ascertain the actual amount, the correct amount to pay to the government as tax for the business. Do we understand that? All right. So that's for taxation. Now, another one is public sector accounting. Public sector accounting. Public sector accounting is just the accounting process that is seen in where? In the public sector, that is in government and government institutions generally. Government and government institutions what? Generally. Do we understand that? All right. So that's that for public sector accounting. All right. For example, we can say that the accounting process that is used by the government of Nigeria is called the public sector. It's called public sector accounting. Now, accounting done for private organization will be private sector accounting. All right, do we understand that? But that's just by the way. Now, the next one, I've talked about auditing, right? I've talked about taxation, talked about public sector accounting. Next one I'll be talking about is what? Forensic accounting. Forensic accounting. All right, forensic accounting is that branch of accounting that traces financial information to support investigation cases. All right, to under forensic accounting, you'll be seeing something like financial crimes investigation and all of that. So you can just say it this way, that forensic accounting is like the law aspect of of accounting, the law, the part of accounting that deals with law, investigation, and crime. All right. So because many transactions actually, sorry, many yes, sorry, many crimes actually have a touch of finance to it, a touch of money to it. So forensic accounting is that branch of accounting that helps to detect fraud, helps to detect crimes, financial crimes, investigate them, and all of that. All right. Is that understood? All right. So let's now move on to the branches we have on the screen. We have accounting principles, accounting concept, and conventions. All right. So this is the branches of accounting branches as a subject matter. Accounting as a subject matter. What are the principles that we have under them? All right. Sorry. What are the branches that we have under them? All right. We have accounting principles as number one. We also have accounting concept. Then we also have accounting conventions. All right. Accounting conventions. Thank you. All right. So accounting principles, as you can see on the screen, refers to rules and regulations or guidelines companies follow while communicating their financial data. The principles focus on the appropriate use of accounting concept and convention in preparing the financial statement. All right. This first branch that we are considering happens to be the basis for concept for the other two branches, which are what? Concept and conventions. Is that taken? All right. So accounting principles. Now, when you hear principles, what do you think about? You think about rules, right? You think about guidelines, all right? You think about those regulations, the things that you have to consider, guidelines that companies have to follow while carrying out what the accounting process or the accounting function. Do we understand that? Now, there is something uh, there's a general rule that where there is no law, there is no sin. So accounting principles can be seen in that light, that they help us, they guide accountants, all right, they guide companies, they guide businesses, they support businesses, they guide principles to businesses to know how to process their financial information and communicate it appropriately and accurately and also objectively. Are we together? So they refer to those rules and guidelines that each company follow while performing their what? Their accounting function and communicating their financial information. All right. So now let's move to accounting concept. Then we move to accounting convention. All right. Now, what are accounting concepts? What are accounting concepts? So generally, accounting concepts are those basic concepts. They are different from principles and conventions in the sense that, all right, we'll be dealing with a list of accounting concepts. business entity concept, going concern concept, realization concept, duality concept, or dual aspect concept. Then we also talk about the cost concept. All right. So now the first accounting concept that we are going to be dealing with is the business entity concept. The business entity concept. The business entity concept. All right. Now I want you to put this into perspective. You don't have to think about it too much. Whenever you hear business entity concept, what comes to your mind? What should come to your mind is that there are two entities involved in a business. The owner of the business and the business itself. They are seen as what? They are seen and treated as what? As separate entities. So the business entity recognize that things affect business only. In other words, the owners of a business are separate from the business, which means the owners and the business are treated as what? As separate entities. All right, is that fine? The owners of the business are treated as what? As separate entities. Now, what are we trying to say? The business entity concept is telling you that if you start a business tomorrow, that business is separate from you, which means you treat the business as a separate economic entity and you as also as a separate what? Separate entity. Do we understand that? All right. So what we are saying is, I told you something about VKA Limited. Let's assume I have a company called VKA Limited. Now, the business entity concept is saying that Victor, am different from VKA Limited, which means if we are two different entities, transactions can happen between the two of us. And in preparing financial statements, we must show transactions that happen between the two of us because we must show that we are actually what? Separate entities. So we must be treated as separate entities. That's going to be seen as a transaction involving two parties. It's going to be seen that I gave money to VKA Enterprises. Now, if I take money from VKA Enterprises, then it's going to be seen as VKA Enterprises gives money to me. Do we understand that? So, business entity concept is actually the basis of the whole accounting process. It's saying that you should treat your business as an entity that is separate from you. All right. Now, the next concept that we're going to be dealing with now is the going concern concept. The going concern concept. Now, the going concern concept states that financial statements are prepared on the basis that the business is a continuing one. That means it will not cease to operate in the future and no major part of the business will be disposed. In other words, we are saying that the going concern concept states that an organization is expected to do what? To operate into the foreseeable future. Which means that when you set up your business, you are not just setting up your business so that you close down tomorrow. No, you are setting up your business so that you operate forever or into the foreseeable future. All right. You are setting up your business as a continuous business. With that, it means that your financial statements are also to be prepared on the basis that your business is what? Is continuing. You are supposed to continually prepare financial statements. And that now brings us to what? To another um, concept undergoing concern known as the periodicity concept. Periodicity concept. Now, why going concern concept rather tells us that our business is a continuing one. Periodicity concept now tells us that there is no way to prepare since we don't know when our business will end. We are saying that our business is operating continuously. Then we cannot say this is the time when we will prepare our financial statement. All right. We cannot wait for a particular time till we do what? Till we prepare our financial statement. Or let me say we cannot wait till our business ends. Because why? Why is it that? that? It means that this foreseeable period, or let me say this continuous period that you expect your business to operate for, has to be broken down into periods. Has to be what? Broken down into periods. Now, your period can be monthly, your period can be semi-annually, that's 6 months, or it can be what? Annually. Now, the most popular periods that we have are what? Annual periods. Annual periods. All right. Now, by having those periods, then you now have a set of periods where over which you can measure your performance. Because one major thing that accounting does is that it tries to measure the financial performance of an organization. All right. Now, the financial information that you have shows that comes out as a result, or that is the output of accounting. Let me put it this way: financial information is the output of accounting. You remember that, right? Now, that financial information shows us the what? The performance of that organization. It also shows us the position of that organization. That is, where does my organization stand? When I want to know how my organization is doing and where my organization stand, or how my organization is standing, when I want to know the standing, the financial standing of my organization, what do I look at? I look at what? My financial information. All right. So the financial information that will be provided has to be provided periodically, which would be monthly, semi-annually, or what? Or annually, depending on the policy adopted by your business or by that particular company. Are we together? Are we together? All right. All right. Now, the next concept that we'll be talking about now is the realization concept. The realization concept. All right. The realization concept. Now, why talking about another name for realization concept is the revenue recognition concept, because it is possible that you know it as what? As revenue recognition concept instead of realization concept. Now, why dealing with the revenue recognition concept or realization concept, they're also going to talk about the accrual concept and what? And the matching concept. Is that fine? All right. Now, realization concept is basically states that what? Revenue is recognized only when sales are made. Now, all of these concepts, as I told you, they answer a basic question in accounting. What do we mean by that? They're saying that any accounting entry is based, or let me say, every accounting generally is based on this concept and conventions. Without this concept and conventions, there will be nothing like accounting. They serve as the bedrock. All right. They serve as the bedrock of accounting. All right. So each accounting concept answers a particular question on the mind of an accountant, or on the mind of a business person. All right. Now, let's ask ourselves, what question does realization concept, otherwise known as revenue recognition concept, what question does it what? Does it answer? All right. Now, the question that is answered here is, when should I recognize my revenue? When should I recognize my revenue? Now, don't forget that revenue is the money made from sales. All right. Revenue is the money made from sales. It is money made from carrying out your day-to-day activities as a business owner or as a business person. So if you sell bread, when you sell bread, you make sales. All right, that's what? Revenue. Do we understand that? That's revenue. So it answers the question. Realization concept answers the question that when should you recognize revenue? Now, realization concept or revenue recognition concept is telling you that your revenue should be recognized. When do you make sales? You make sales when you actually transfer goods and services. Do we understand that? You make sales when you do what? When you make sales when you transfer your goods and services. Now, moving on to accrual and matching concept. Now, they are the same concept and they are similar to realization concept. All right. Now, the accrual concept states that revenue or income should be recognized when earned and not necessarily when cash is received. All right. While um, it also states that expenses should be recognized while incurred and not necessarily when cash is paid. So Accra concept states that what revenue income should be recognized when earned and not necessarily when cash is received. Now, he also states that your expense should be recognized when incurred and not necessarily when what when cash is paid. Now, what does that mean? It means that you see, okay. Now, what do we mean by when income is earned? Income is earned when there is a transfer of goods and services. All right, and expenses incurred when you enjoy goods and services. Do we understand? When you buy goods or when you enjoy services. All right. Now, what does that mean? It basically means that as an organization or as a business person, somebody can come to me. All right. Now, let's take a very practical example. I can my VK Limited, my hypothetical company. All right. Once Now, let's assume that we sell a lot of things. We are into different lines of business. Now, one particular line of business is that we sell rice. That we are into is rice. All right, the sale of rice. Now, when somebody comes and says, "Oh, VK, how are you doing? I want to get a bag of rice." Now, what happens? There is a possibility that the person will give me money immediately and collect rice. There's also a possibility that the person will be like, "All right, I want to buy rice, but I need the rice now, but I don't have the cash ready. I'll pay you the cash next week or next month or next year." Do you understand that? All right, now in that case, I have to recognize the transaction. Why? Because I have actually sold rice. So revenue, the income on the sale of that rice should be recognized at that moment when I've sold the rice. All right, not by next week or next year when I'm going to get paid. Do you understand that? All right. So that's for Accra concept. Now, of course, matching concept is similar. Matching concept is actually under Accra concept, and it's saying that the income earned in a particular period should be matched against what? Against the expenses incurred in that period. That means any money I make in a particular period, I should match it, compare it, match it against what? The expenses that I've incurred in that particular period. All right. Now, by so doing, I would be able to do what? To make a profit, or I'll be able to ascertain that this is the profit that I have what? That I have made in this period. Is that fine? All right. So now let's move on to the next concept, dual aspect concept. Dual aspect concept. Now don't forget, no, all right. Now another name for dual aspect concept is duality concept. Duality concept is another name for what? Duality concept is another name for what? For dual aspect concept. Now, don't forget I said all of these concepts answer what? A particular question. Don't forget that. Now, so let's think about it. What questions does the duality concept answer? All right. What question does he answer? So this principle is based on the fact that all transactions must have two aspects, debit and credit. There must be a giver and a receiver. Now, what are we saying? The dual aspect concept is actually the basis for double entry principle. It was because they came and they discovered something. That was why we agreed, or that's why we have the what? The double entry principle. You know double entry principle, you debit. Double entry principle means there must be a debit and there must be a what? A credit. Now, why is that? It is because for for every transactions there are two parties. Think about it. I cannot teach without a student, and you cannot learn without a tutor, rather. So at the end of the day, there is what? At the end of the day, there are two parties involved in this transaction of knowledge. So let's assume that this is a transaction, right? I'm giving you something, I'm giving you something, right? If I stretch my hand to give you something, you must also stretch your hand to collect or to receive it. All right. So you must also stretch your hand to receive it. So in that case, there is a giver and a receiver. Now, because there is a giver and a receiver, um, while recording transactions, you must also recognize the two aspects of that transactions, which is the perspective of the giver and the perspective of the receiver. All right. That brings us to the fact that every transaction now has what? Debit and what? And credit. Debit and what? And credit. Debit and what? And credit. All right. So the duality concept is telling you that every transaction has two aspects, and because of that, every transaction should be recorded in two accounts. An account where it is going to be debited, and the other account where it is going to be what? Credited. And don't forget the general rule of double entry. You debit the dash and you credit the dash. Do I need to tell you that? Would you debit? Think about it. All right. You debit the receiver and you credit the giver. Don't forget that. It's like the golden rule of accounting. Debit the receiver, you credit the giver. And why is that? So that we can account for the two aspects of a transaction according to the dual aspect of the duality concept. All right. Now, to the next one. All right. Cost concept. Cost concept, otherwise known as the historical cost concept. Historical cost concept. Now, this one states that the value of assets should be recorded or should be shown, right, at the cost of acquisition. What does cost of acquisition mean? It means cost of purchase. All right. Now, when you buy an asset, we are saying that you should show the value of your asset. The value of your asset should be the amount you bought it. For example, you have a phone. All right. When you are asked the value of your phone, the if you want to record rather the value of your phone at the amount you bought it, whatever the amount is. All right. Now it says the accountant cannot value the asset in terms of future returns. That is, you cannot value your phone in terms of what you will gain from that phone according to the historical cost concept. But you should record it on the basis of the actual amount involved. Do we understand that? Now, maybe I should give a little explanation again to that. It basically means that when you went to buy your phone, say you paid 250,000 or say 350,000 to purchase your phone. Right now, if you want to record the value of your phone, you want to show your phone as an asset in your books, you have to show it at what? At the amount that you bought the phone. That's what we know as what? The historical cost concept. So the historical cost concept is now telling you that you should maintain the value of your asset was bought at the time of purchase. At the time of purchase. All right. That's that for accounting concept. Now let's move to the final piece of the puzzle, and that's what? Accounting conventions. Accounting conventions. All right. We'll talk about three conventions, and then that will be it. So now we have first one, materiality convention. We also talk about the conservatism convention. Then we also talk about the consistency. We also talk about the consistency convention. All right. Now, materiality convention. Now, this puts into consideration amount of material value which must be recorded. And it says that certain economic events should not be reported if the result of the event will not significant. You should have asked me this question, right? What question does this answer? The question that this answers is, do I have to make a fuss if the result of the event about every little transaction? Do I actually have to care about every little transaction? Although, of course, as an accountant, you have to care. But we are saying that there are some transactions that if there is an omission, so much concern. All right, those transactions are called immaterial transactions. IMMATERIAL. Now, transactions that if you make a little bit of mistake, you have to be very concerned about are called what? Material transactions. MATERIAL. The opposite of that is immaterial, right? So material transactions. Now, materiality generally, you see something like an item is material if an omission means you totally left it out, or a misstatement means you showed it incorrectly. If that omission or misstatement will affect your financial statement significantly, then that item is material. If that item, and why is that? It is because if it significantly, right? I hope we are still together. I think the students link. All right, we'll get that sorted. All right. So now, if all financial information are recognized correctly, in that same line, said it will significantly affect financial statement. All right. Now, if it significantly affect the financial statement, it also means that it is also going to have an effect on what? It will have an impact on the decisions that are made by the users of financial statement. All right, because at the end of the day, the major reason you are carrying out the accounting process is what? So that you can provide financial information. Don't forget, useful financial information for the users of financial information to make decision. All right. So if the omission or misstatement will affect the decision that is going to be made by, sorry, the decisions that will be made by the users of financial statement, then you regard that particular item, information, or transaction as what? As material. That's what materiality convention talks about. That's the question that he answers. All right. So up to the next one. Now the next one, on to the next rather. Now the next convention that we'll be talking about here is the conservatism convention rather. Now that might sound very big to you, but it's just English. The common name for conservatism is what? Prudency. Prudency concept. Oh, sorry, prudency convention. All right, prudency convention. Now, just like the word sounds, or just like the normal meaning, prudency convention is telling you that as an accountant you should be prudent, you should be cautious. All right. Now, what does being prudent mean? You can check out the dictionary meaning. It actually means that um, you must pay attention to the movement of money. Is that fine? You must do what? Pay attention to the movement of money and your recognition of profit, to the movement of value. So let me read. So looking at what we have on the slide, you see that this principle or this convention has to do with being cautious. All right, you have to be cautious. The accountant now, it states, prudence concept is saying, it actually states that um income should not, under any circumstance, should never be what? Anticipated. But any possible losses should be anticipated and duly provided for. Apologies. Um, and duly provided for. All right. So it also states that if the accountant is faced with the choice between two methods of valuing an asset, the accountant should do what? Should choose the method of valuation that will give the lower value. That will give the lower value. All right. Now we have been saying that what question is this answering? All right. So now we are saying that the accountant has to tread with caution. The question that this answers, that this prudency or conservatism convention answers, is that what should I do when I'm faced with a choice between choosing a greater value or a lower value as an accountant? It's saying that you should actually go for what will show your business in as a business with a lower value. Do we understand that? Are we together? All right, what we are saying is that when you anticipate income, there's a likelihood that you overstate your profit. By overstating your profit, it means that you are most likely calling yourself what you are not. Do you understand that? So, and that's a very dangerous position to be in. It is better. So, what prudence concept is saying is that it's better to understate your profit. I mean, it's better to think that you have 400,000 when you actually have 100,000 than to think that you have 500,000 when you actually have what, 400,000. I hope that's not confusing. At every point in time, you must, let me say it again. It is better to have 500,000 and think you have 400,000 than have 400,000 and think you have 500,000. All right. So that's what it means. So when you anticipate income, you are also saying that your future profit will be greater. But you know that life is filled with risk. There's a likelihood that that income will not come. It's only certain income that should be recognized. That's what Prudence is saying. Any income that is not certain, that is uncertain, should be ruled out. You should only recognize income when you earn it. When you have not earned it, don't try it at all. It is still a future income. Don't anticipate it. But when you have losses, you should do well to anticipate future losses and provide for them, create provisions for them. That's what gives rise to items such as provision for doubtful debt. When you think that you might probably lose money as a result of your debtor defaulting in payment. Maybe if you are saying that if your debtor refuses to pay, then you will not make that particular money. So you provide for it because it's a possible loss. All right, because you don't know whether they will pay or not. All right. So by so doing, your profit is lower. But at the end of the day, you might get a greater profit. But if you don't get a greater profit, you will not get a profit lower than that. Do you understand? Are we together? All right. So that's what um, prudency and conservatism is all about. All right. Now, the next one that I'll be talking about is the consistency concept. The consistency concept. Now, the consistency concept works, or convention rather, works along with the consistency convention works along with periodicity. All right, we mentioned that under periodicity concept, we are saying under periodicity concept, we mentioned that the foreseeable future, the continuous life of an organization will be what? Will be divided into um short period. For example, month, 6 months, all right, or annually, which is what is mostly used. All right. Now, consistency concept is saying that if you use a particular method to value a transaction in this period, all right, you should also use the same thing next period. That's basically what it's saying. If you check, it says this principle states that similar transactions within the same period and between one period and another must be dealt with in a consistent manner. Do we understand that? It means that if there should be no inconsistency in your treatment of similar transactions, whether in the same period or in different periods. And why is that? Why is that? The reason is that consistency helps or aids comparability. Consistency aids comparability. What we are saying is that without consistency, there will be no comparability. And Comparability is one of the features that makes financial information useful, right? It makes financial information is one of the enhancing qualitative characteristics of financial statement, which we are still going to talk about. Right? We will talk about the fundamental qualitative characteristics, which is faithful representation and relevance. All right. Then we also talk about enhancing qualitative characteristics of financial information, where you talk about verifiability, you talk about comparability, you talk about understandability, and you talk about what? Timeliness. Timeliness. All right. So what we are trying to say is that comparability, if information is not comparable, is actually useless. All right. Because if you tell me, if you show me, we said accounting shows financial performance. All right. Now, for example, I show you my financial statement and you say, all right, this is good. You cannot totally know if it is really good except you have a benchmark to compare it with. Do we understand that? For example, if let's assume I'm sharing money to every member, I'm giving gifts, monetary gifts to every member of this class. All right. Now, some if I give a particular person 5,000 naira, the person might be happy and that, oh wow, my tutor Victor is generous. He gave me a gift of 5,000 naira. Gave me a gift of what? Of 5,000 naira. All right. And I mean, that's nice. All right. But let's now assume that you ask a few of your mates and then they tell you that I gave them 10,000 naira. Another person says I gave them 50,000 naira. In that point, you're like, oh, well, you already thought that I gave you a very big amount. All right. But when you see that there are people that have collected more than you, you're like, oh, wow, maybe what I collected is not that big after all. Do you understand that? All right. So it's consistency that helps us to what? So that's what comparability means. All right. That's how comparability works to show the value of what? Of financial information. So consistency is what is telling us that the same policies should be repeated over time. All right. You should do the same things over time. Similar transactions should be treated the same way over time. It's not that don't treat an item as an asset now, and the next time you are treating it as an expense. Do you understand that? Are we together? You should treat it as an asset consistently. Of course, your first treatment must be seen to be what? To be must be seen to be correct. Must be seen to be correct. Right? Is that fine? Yeah. All right. Should we take, so let's say, a very short example around consistency. All right. So, consistency concept. All right. So, I hope you understand that now. So, consistency just means do the same thing over time. All right. All right. Right. Now, now there is a major reason why consistency is actually very important. It is because at times there are many policies that could be adopted to a particular transaction. I mean, there are many ways that we should, for example, a transaction like stock, an item like stock, or otherwise known as inventory. There are many ways that you can treat it, right? You can use the FIFO method, you can use the LIFO method, you can use the weighted average method, simple average method, for example. All right. Now, consistency is saying that if you use FIFO last year, don't use LIFO this year. If you want to use FIFO, use FIFO and use it consistently. Use FIFO this year, use the next year, use it the year after, and so on, so that your financial statement will be comparable. If it's weighted average you want to use, stick with it. That's what consistency means. All right, that's what consistency means. All right, so to aid comparability, you are to treat your transactions consistently with the same policy. The only reason you're allowed to change is when by changing it, your financial statement will be more accurate. All right, your financial statement will be more accurate, or when there is a law to change. If not, you are supposed to do what? To treat financial transactions in a consistent manner. All right, so that's the end of this introductory class. It's kind of short because it's an introductory class, and as time goes on, we'll move into deeper parts of accounting, or let me say the other aspect of the syllabus. So help us God. All right. So, but before we go, I want to be sure that there is no question. In case there is any question, you can drop it in the chat box, and I'm definitely going to attempt it before we end. All right, before we end this class. But before we go, let's just attempt these questions just as a short quiz. Right, just as a short quiz. So I'm going to read out the question. If you are with me, you can drop your answers in the chat box. Yeah, you can drop your answers in the chat box, and then I consider your answer, and then of course I will describe my answer to you and tell you why that is the answer. I'll tell you why that is the answer. All right, question 1. The assumption that a business will continue to exist into the foreseeable future is recognized by a concept called dash. A. Matching concept. B. Business entity concept. C. Going concern concept. And D. Historical cost concept. Matching concept, business entity, going concern, historical cost. Should I be expecting an answer in the chat box? All right. So clearly, is going concern that tells us, that assumes that a business will continue to exist into the foreseeable future. That means a business is a continuing concern, a continuing entity. All right. So just like the word means, the word is going concern, it means that this business is going on, going on, going on, going on, going on. All right. So the answer to this question is C. The answer to this question is C. Right. Now, our next question 2, is a person who prepares, analyzes, and interprets financial statement is known as dash. B. A cashier. B. A bookkeeper. C. An accountant. D. An analyst. Cashier, bookkeeper, accountant, analyst. Cashier, bookkeeper, accountant, analyst. Cashier, bookkeeper, accountant, analyst. Cashier, bookkeeper, accountant, analyst. All right. Now you have to pay attention to details when it comes to question, when it comes to answering your questions. And even while writing your exams, I want you to have this at the back of your mind too. Pay rapt attention to details, because for objective questions, candidates can be misled by little details. All right. For example, if you have a question like so is not, you have to pay attention to the word not there. All right. So now you have cashier, bookkeeper, accountant, analyst. Now, obviously, we did not even say anything about cashier. So a cashier will just be somebody that receives cash. You see, that takes payment on behalf of an organization. Now, we know who a bookkeeper is. You said anybody that records account is called what? A bookkeeper. All right, somebody that keeps the books of an organization, that participate in the bookkeeping process. And don't forget that the bookkeeping process is limited to what? Record keeping. Accountant that prepares financial statement, analyzes financial statement, and also interprets financial statement. All right. Now, an analyst will be someone that just analyzes financial statement. Is that fine? All right. Somebody that just analyzes financial statement. But for somebody that actually prepares financial statement, analyzes them and interprets them, it is that kind of person is called an accountant. So pay attention to that details. Prepare, analyze, and interpret. It is those details that you need to do what? Oh, thank you. Thank you. All right. It is those details that you need to do what? To provide your answer, or to provide the correct answer to what? To provide the correct answer to the question. All right. Uh, as I fondly say, this is this and that is that. So that is that about that. So that will be all for today's lecture, for today's class. But don't forget to take your practice test immediately after this class. Take your practice test immediately after this class. All right, please have it at the back of your mind that the class has not ended until you do what? Until you take your practice test. As they say, practice makes perfection. All right. As you practice something, you get better at doing it. All right. You get better at doing it. So those practice tests are see them as a simulation of your real life exams that are coming up. All right, so endeavor to take your practice test. I wish you all the best in your as you go on in your preparation. Thank you so much for having me. See you next class.